So today we're going to be talking about trading intraday market moves with Nadex spreads. And we don't necessarily consider this to be, a day trade only strategy. There are weekly spreads listed for some symbols, so I can actually use the Nadex spread market to take different types of approaches where futures would expose me to an inordinate amount of risk, right? I don't want to ever be in a situation where I could possibly blow out my account. And what's nice about Nadex spreads and of course Nadex binary options is that I can guarantee that that's not going to happen to me by using these products, and that's something that you really can't replicate in underlying futures. There's no way for me to have the certainty about my risk and my risk reward that I am given by these products in the futures market. So with that, I want to read our standard risk disclaimers here. Trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not indicative of future results. Nadex instruments include forex, stock indexes, commodity futures, and economic events. Nadex binary options and spreads can be volatile and investors risk losing their investment on any given transaction. However, the limited risk nature of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to U.S. regulatory oversight by the CFTC, and this is our standard boilerplate risk disclaimer. I'm not going to read the whole thing, but essentially what this says is that all of the examples that we go over here are hypothetical examples only. These are not recommendations for trades, and if you have questions about execution, margin, capital requirements, and things like that, to contact your broker or registered investment advisor. And if you're seeing this presentation, then you would adhere to all of our disclaimers on optionhacker.com and alphashark.com. Okay. So my name is James Ramelli, for those of you that don't know who I am. I'm not going to talk about myself for too long here because we do have presentation to get through, but I am an active trader and educator here at Alpha Shark Trading. Maybe you've seen me on TV in the past. I haven't done TV quite as much recently, but used to be on CNBC, Bloomberg, Fox Business, BNN Canada, WGN here out of Chicago, which was syndicated all around the country, and would do that about 3 or 4 times a week. Also have written quite a bit for Futures Magazine, Active Trader Magazine, Resource Investor Magazine, CME Open Markets Magazine, and have contributed to a number of other financial news outlets. And essentially what my focus is derivative products, which is something that has given me quite a bit of exposure to basically every derivative market around there. And what we're inspiring resume, thank you. And what that means is that I have a really good knowledge base about derivatives. I also have a degree from Illinois in derivatives trading and financial engineering. Well, that's my concentration inside of finance. But what that means, and I'm not trying to brag, but what that means is that I have a really good understanding of the trade-offs between different types of derivatives products and the benefits and costs associated with trading one over the other. And what I love about the world of derivatives is that it gives a trader the choice to approach the same type of theory or idea with 24 different types of approaches. And this is why I love Nadex products so much, is because in that derivative space they essentially have taken the best of all of the other derivatives contracts out there that exist, combined them, and put together these products that are available on all these listed markets. They're absolutely fantastic for retail traders who are interested in trading markets that otherwise would require them to have an insane amount of capital or a really strong knowledge of very specific and esoteric types of settlement procedures and contract rules. So with that, I want to jump into the presentation here. Now we're going to do a quick overview of binary options, because understanding these is important to understanding the spreads as well. But a binary option is a financial instrument with a payoff that is a fixed amount or nothing at all. Nadex defines them as a security that asks a simple yes or no question. Will market X be above price Y at time Z? If it is, the option settles at full value, or $100. If it's not, it goes to zero. Pretty simple. So there's a fixed payoff, meaning that there's only two scenarios at expiration. Either it goes to full value or zero. But what's nice about that is that it gives a trader a guaranteed payoff and reward structure if they're right, and a guaranteed maximum loss if they're wrong. So with that, I can manage my risk very, very effectively. It's very difficult to do that in futures, and even kind of difficult to do it in options on futures. I know a lot of people might disagree with that, but there's other risks associated with options on futures, such as the risk of early exercise, pin risk, things like that, that we don't really have to worry about as much with binary options. So how many of you here have traded a binary option before on Nadex? How many of you have traded before? Yeah, pretty much all of you, right? Now, this is the point that I was trying to make earlier. Of all of you that have traded binary options on Nadex, how many of you have traded spreads in the past? How many of you have traded Nadex spreads? Right, yeah. See, and that blows my mind that so many of you answered that question as I expected, that you haven't done it before. And I would imagine that the reason is probably because you don't have a very solid understanding of how they work, right? And they're not any more complicated than understanding the actual binary options. Once we go through this, I think you guys are going to realize that spreads, very, very simple to understand, very simple to calculate my maximum risk, maximum reward, and where, you know, what I want the market to do, and essentially offers me access to markets that I wouldn't be able to trade with futures. So Nadex spreads settle at a floor or ceiling price, or somewhere in between, depending on where the market is. Okay, a trader can buy and sell the spread for some price in between the spread's floor and ceiling price. So just like binary options, there is a maximum value for the spread, the most it can be worth, and a minimum value, the least it can be worth, which is zero. So the main difference is in the payoffs. There isn't just two potential settlement values. With binary options, they either settle at 0 or they settle at 100. With Nadex spreads, they can settle for a price anywhere in between the floor and ceiling price of the spread. Okay? So what that means is that as a trader, I can trade these with a smaller volatility in my returns, because there's not this fixed payoff of 100 or 0. It's not a all or nothing type of setup. I can put on a trade, still have that defined risk versus reward, risk versus maximum reward, but there's possibilities that it settles for somewhere in between there. If I buy a binary option for 50 bucks and I know that I'm going to hold it till expiry, it's either going to be worth 100 or worth 0. So I'm either going to make 50 or lose 50. On expiration, there's no chance for me to, you know, make 40 or to lose 30. With spreads, the settlement values can happen anywhere in between the floor and ceiling. And what's nice about them is that they're standardized and settle with the same with a process that's the same. So you don't really have to know all of the kind of minutia on each individual product. It's not the case with futures. Let me ask you guys this question. How many of you can tell me right now, without having to look it up, what the tick value is for British pound futures? Right, no idea, right? And what about for the euro futures? What about for the yen futures? What about for the Aussie dollar futures? Right, they're different, right? What about for crude oil? What about for nat gas? What about for something like, you know, soybeans or corn? It's completely different in the futures market. What's nice about Nadex spreads is that this doesn't really, yeah, it is that the tick values are the same for all the spreads across all those products. So I don't have to have this really complicated approach to understanding exactly what my risk is in each of these different things. I can put trades on and know that it's standardized across these markets. So what this means is that it provides me as a trader with access to a number of markets that I might not be able to trade otherwise, right? So we're going to take a look at the contract specs for a couple of different examples here. The examples are a little bit older, but after that we'll go through some live ones, and I think you guys will have a much better understanding of how these contracts actually work. Okay, so before we jump into that, someone said, but don't the Greeks have to be taken into consideration regarding spread trading, thus making them more complicated? Okay, yeah, so the dynamics of how these things are priced, it's a derivative contract, right? So it's not, as simple as, looking at the price of the futures and understanding what the contract itself is worth, right? But as we go through these examples, I think you're going to see that calculating your risk and reward and your tick values and things like that are far more simple with these spreads. And I think you'll see what the best applications for them are as we go through the presentation as well. So just kind of bear with me for a second here. So before we get into that, I want to ask you guys a quick question about the three contracts that you see listed here. Well, how about just this one? If we were to trade crude oil futures, meaning the underlying futures, how much money do you think would be appropriate to have in an account to actively trade crude oil futures? And keep in mind that a $1 move in the futures equals to a $1,000 change in the contract value. I mean, we all know how much the oil market moves, right? Take a look at days like today even. Market's up 71 cents. That's $710 per one lot. $5,000? No, I would need way more than $5,000. I would not feel comfortable actively trading crude oil futures with anything less than probably $50,000 in my account, right? Because there's so much risk in every single trade. I mean, what's the average true range in a day for crude oil futures? It's probably pretty high. $1.28. So that means in an average day, the range moves $1.28 in crude oil futures. That's $1,280 per one lot. Per one lot for one contract. So it's incredibly, incredibly expensive margin-wise and risk-wise to trade these contracts like this. S&P and Dow futures are, much smaller, but still very capital intensive. Just keep that in mind as we go through these examples here. So the first example is in the CME E-mini S&P 500 futures. And like I said, it's a little bit older. The market's a little higher than this now. Actually crossed 2,300 today, believe it or not. But here we have an example with the futures trading at 22.53. Okay. I go and buy the US 500 2230 2270 daily spread for 22.53. Okay. My risk in this trade is $230 per one lot. My reward in this trade is $170 per one lot, and the option expires at the end of the day. The spread expires at the end of the day. So let's break this trade down. Here is my floor and ceiling price. 22.30 is the floor, 22.70 is the ceiling. With the futures trading at 22.53, I know that my downside risk here is 23 points because the spread cannot settle below 22.30. My upside profit potential is 17 points. It cannot settle above 22.70. Okay? So what can you notice about the total risk in this trade relative to the risk that I would have to take on in the underlying? Well, S&P futures trade with a contract value of what? How much is a 1 point move in the E-mini S&P futures worth? Several people said they knew this one, not the other contracts. Yeah, $50, right? So if my trade setup was like this in the futures, if I'm getting long here with a stop at 22.30 and a profit target at 22.70, what would my risk and reward setup be in the S&P futures? Well, 23 points to the downside times $50 a point is $1,150. So this would be $1,150 worth of risk with 17-point upside potential on $850 worth of potential reward. Okay? So what do you notice here? The contract, much smaller, right? Much, much smaller. I might not be comfortable with taking this level of risk if I had a smaller account, but how else am I going to have a direct approach to speculating on the value of the CME E-mini S&P 500 futures? If I am not willing to risk this much capital, well, then I can't trade the futures. The spread gives me the ability to put on this position, structure it just like this, and keep in mind that, you know, I don't have to risk everything to the floor of the spread. I don't have to wait till it goes above the ceiling of the spread to take profits either. I can exit for any price that this is trading at, you know, in between these floor and ceiling levels, right? So what that means is that I can basically trade this almost like a mini futures contract, and it's not going to trade tick for tick. We're going to go over some examples later. I'm going to show you that, but it's pretty darn close, particularly when we're in between the strikes of the spread. So what that means is that I can approach this with a much smaller account and with much less risk than I would need to if I was trading the futures. Okay? Does everyone understand this so far? Do we all see how this is a much less risky approach to trading these markets compared to the underlying futures? Because that's the main point that I'm trying to make with these examples. We'll go over some actual trade setups and ideas on how I can, you know, take advantage of these moves or take advantage of trade setups using these products. But this is the main differentiator between Nadex spreads and the underlying futures. So look at the floor and ceiling as TP. Not sure what you mean by that, Michael, sorry. So no, what I'm saying is that, you know, in the floor and ceiling, you can calculate, because it cannot settle above or below these levels, you can figure out what your risk and reward is. How you manage the trade after you put it on, you know, that's up to you. If you're using some type of technical indicator, you know, maybe you're waiting for something to develop on the chart to understand to take an exit. But the drawback of these particular spreads, just like with any derivative, there's trade-offs, right? Not only is my risk limited, but my reward is limited as well, right? And no, you know, I don't have to consider the floor and ceiling to be my profit target or my stop loss either. Like I said, if, you know, I put this on and, you know, I tell myself, all right, you know what, I only really want to risk 5 points here. So if the market drops to 22.48, then I'm going to get out. If the market rallies to, you know, and then let's say I want to risk 5 points to make 10 points. If the market sells off to 22.48, I can get out of the spread. If the market rallies to 22.63, I can get out of the spread there, right? And I've set up a risk-reward ratio of 2 to 1 inside of the floor and ceiling value of this spread. If I'm fine with the levels that I have now, meaning if I'm fine risking 23 to make 17, well, then I just leave it. I don't have to manage it. Does that make sense, Michael? Let's go over another example, excuse me, in a different product, like crude oil. So here we have crude oil futures trading at 53.45, a little bit off of what the current price is, but that's okay. In this example, with the market at 53.45, I'm going to buy the crude oil 51.5, 56.5 daily spread for 53.45. My risk in this trade is $195 per one lot. My reward is $305 per one lot. Now let's do the same analysis that we just did in the S&P contract. How much is this spread? How many points wide is this spread? How many points wide is this spread? 5 points, right? So in futures, this would equal a $5,000 wide move, right? Per one lot, per one lot. If we move from 51.5 to 56.5, that's a $5,000 change in the value of the contract. As you can see here, in the Nadex spread, my risk and reward, the value of this spread at most can be, what, 500 bucks. So the spread lets me trade something that is a tenth of the size of the underlying contract. Right? So someone asked a little bit earlier, what would, you know, someone said, you know, maybe I can trade crude oil futures with $5,000. I said, absolutely not. There's no chance. I would want at least $50,000 in reserve capital to try to speculate on crude oil futures during the day. But with this particular setup, the contract's a tenth of the size, right? My downside risk from 53.45 is $1.90, 1.95 points. It's $195 per one lot. My upside potential is from 53.45 to 56.5. That gives me an upside reward potential of $305 per one lot. So in this example, I'm getting long crude oil. Given the floor and ceiling levels in the spread, how does the risk compare to the underlying futures when approaching it this way? Let me put it this way. How many of you would feel comfortable with this trade setup if the risk looked more like this? If it looked a little bit more like this. Per one lot, per contract. My wife would kill me. I like that. Yeah, it's an insane amount of risk. So this is a pretty simple trade setup, right? This is a pretty simple day trade setup. A 5-point wide, spread is what we're looking at. Rarely does the market move $5 in a day in crude oil, but at the same time, I'm still required to take a lot of risk to trade that futures contract, right? And here we are now with something that's way smaller. How many of you are comfortable with this dynamic, though? Pretty much everyone that trades would be able to approach it with that, right? That's fine. Much better. And just like we went over this example of me buying this particular spread, I could take the other side of this trade. If I were to sell it to get short, this would flip around, right? I can buy or sell these, and it's a fantastic way to approach these markets with a fraction of the risk that it would be required in the underlying futures. So here's one more example. In the Dow, obviously we're above 19,717 now. But here we have a spread in the Dow, and what's nice about this is that it's a really wide spread, right? How wide is this? This is a daily spread that's 800 points wide. So what that means is that there's a lot of room in between the floor and ceiling for this thing to trade around. It's going to trade very closely to the underlying market in between here, and this is my maximum risk and maximum reward. Just like before, someone tell me this, how many, what's the tick value for Dow futures? What's the tick value for Dow futures? Yeah, $5. So a spread this wide in the Dow futures would be a huge, huge spread. It's $4,000 wide spread between the floor and ceiling. Here, it's much smaller, right? Much, much smaller. So again, I can approach this the exact same way, but with a much smaller level of risk, okay? So what's really nice about these is that it's kind of a happy blend of the dynamics that you would get in the futures market, this really kind of clean way to approach speculating in all these different contracts, with the capital, I guess, relief that some of the ETFs out there give you, right? Because this isn't a new concept, right? Taking something that is very risky, creating a product that allows a trader to approach it with less risk, and then giving them the ability to trade it, right? All of the index ETFs seek to do this already, right? But what's nice about this is that it always offers a trader a more capital efficient approach to the markets that they want to trade. And because of settlement nature, there's a fixed amount of capital required when entering the trade. So let's compare this to something like in an ETF. The SPY, the S&P futures are at 2305 right now, okay? The SPY is trading around $230. Smaller, much smaller amount of risk. But for a day trader, there still is this really heavy capital requirement necessary to trade the SPY during the day. Why is that? The pattern day trade rule. Same thing with the Qs, the diamond, the IWM, any of the commodity ETFs that are out there, the GLD, the SLV, all of those things are subject to the pattern day trade rule. So the day trader isn't really given much of a benefit for trading these cheaper products via the ETFs. I still need to have a lot of capital to hold them in margin during the day, and I also know that I can't take more than 3 day trades in a 5-day rolling period unless I have $25,000 in my account. So is the ETF, which is smaller, really a solution for the day trader with less than $25,000 in their account? Does it matter that these ETFs exist and are cheaper than the underlying indices? No, I can't trade them as a day trader because my account's going to get restricted. Spreads, Nadex spreads, not subject to these rules. So it takes this concept of making a smaller, a cheaper, less capital-intensive product, but also gives me the freedom and ability to day trade them as much as I want. Okay? And what's nice about it is that any product you can name, there's going to be a spread market for it. The Dow, the S&P, the Nasdaq, the Russell, the FTSE, the DAX, all the commodities I would want to trade: silver, gold, copper, oil, gas, corn, soybeans, and then pretty much every major currency pair that's out there. On this list, do you guys see anything missing that you wouldn't, that you would want to see, and a market that you would want to trade? Or does this pretty much cover everything? The one thing that I think people usually say is bonds, right? Maybe they'd like to trade bonds, but all of these markets, how many of you see something up here, a market that you would have liked to try to trade at some point in your trading career but couldn't or didn't because of the risk involved or the amount of capital that was required to approach one of these? Yeah, all of you, everybody raise their hand, right? Because there's a market on here that's the case for every single one of you. All of us want to speculate on oil. It's hard to do it unless you have a lot of capital. All of us like to trade these products. If you're a technical trader who's using chart setups, you may have found that you've got a signal that works great in crude oil futures or great in a specific currency pair, but you've never deployed it because you don't really have a way to approach it given the amount of capital that you have. Now you do. Whereas the binary options are fantastic for trading around catalyst events or using stiff levels of support and resistance to try and predict where markets might break out or where they may fade against that support or resistance. The spreads are a much kind of more direct way to trade the price of the underlying, right? Does this make sense to everybody? So next here we're gonna jump into a couple of examples on the slides, and then we'll go into the actual example, some actual examples from market prices today. No. If you have questions, please interrupt me. I don't really like to just kind of sit here and like rattle off of the presentation slides. Like if you guys are confused on something, stop me, because I guarantee you with the number of people in here that if you guys are, if someone has a question about something, there's probably 10 other people that have the same question that just won't ask for whatever reason. But is this clear to everyone so far? What is the difference between an in-the-money spread and an in-the-money binary? That is a really good question. So Brian, because we'll look at that once we jump into some of the live examples, right? Because it'll be much easier to make that comparison with actual prices that we're looking at in real time. Well, in my demo account. Okay. Alrighty. So when it comes to trading these spreads, there isn't really any like special approach that I have other than the same methods that I would use to trade anything else, right? I'm a big proponent and advocate of the Ichimoku Cloud as a technical analysis method. I'm also a big proponent of market profile and volume profile for futures trading. And in addition to that, I have a basket of other indicators that I use for different types of breakout setups and day trade signals. What's nice is that I can take all of those, everything that I just described and the things that I'm already using in other parts of the market, and apply them to the spread trade. Because what's the main difference? The main difference between trading these underlying markets and the spreads is the amount of capital that I have to put into it, the amount of risk that I need to take on, right? All that really does is change my approach to risk management. It makes it easier for me to do this with these different products. It gives me the ability to trade the strategies that I'm already using and apply them in markets that I might not have been able to otherwise. All right, so whatever your strategy is now, you can take it and tweak it to apply it to trading these spreads, right? So let's go over an example here. Nadex lists spreads with a number of intraday and daily expirations to choose from. So that means that I can use these contracts as a vehicle for day trades without all the risk needed to trade the futures. So we'll look at a couple of examples here, and I actually think that, yeah, we'll jump into live examples here in a second. But before we do, I want to talk about some of the other trade-offs here. I can use methods from other strategies to find day trade setups for spreads. We'll look at some examples with the Ichimoku Cloud, but I can take any other technical indicator that I already have and use it as well. So let's jump into, and we will start with S&P because it's probably one of the more popular ones, right? We will start with S&P, and here we have the Nadex platform. I'm going to go ahead and close these out. And if you notice, they list them out like this: binary spreads, binary spreads, binary spreads. So I'm going to click on the spread drop down, and here are all my indices spreads. And as you can see, I can trade the FTSE, the DAX, the NASDAQ, the S&P 500, the Russell, and the Dow. Now, in general, if we were to compare all of these contracts to each other in the futures market, they'd be all over the place. The amount of margin, the amount of the tick values, the amount of capital that I would be required to trade them, and not even that, the exchange and access that I have from them to them. I mean, there's futures that are listed on the CME for these foreign indices, but I don't really trade that well, right? So if I want to have a good approach to this, this is a really easy way to access it. So let's open up the daily spread markets here for the S&P futures. Okay, so let's go over an example in, say, something where, you know, I'm expecting the market to have a move to the upside through the rest of the day. Okay, so how would I approach that? What's the best way for me to approach that? Well, there's a couple of different choices that you see here, and I'm going to try to zoom in a little bit. Is that better? Can you guys see better now? Can everybody see this well? Okay, cool. All right, so where is the market right now? Right around 2304, right? So let's say that I wanted to get long. Here you can see, and this is where the market makers are getting their edge, right? Here you can see that the bid is 2303.70 at 2304.30, okay? So the mid-market price is pretty close to where the underlying market is right now. Now let me ask you guys this: is this really that wide of a spread? Is this like a ton of edge that is getting eaten up by the market maker in this particular example? I mean, it's like 0.6 of a point wide, right? It's not that big of a spread. So, you know, when I do this, I can still approach it with an order that would try to get me in at mid-market. I don't know why this ticket's not loading. Maybe I need to zoom out. Oh, there we go. Here we go. So let's say that I wanted to try and get in at the mid-market price, right at 2304. We'll take a look. My risk and reward are defined. The floor of the spread is 22.90, which is 14 points below my current level, right? $140 in risk. The ceiling of the spread is 23.30. Now, do I really think that the market has a decent chance of rallying 27 points by the end of the day? Does anyone here think that it's possible that the market rallies 27 points in the next, 3 hours? Less than that. No, it'd be very, very unlikely for that to happen, right? Not today, right? On any day, that would be very unlikely for that to happen, right? That would be a 40 handle move in the S&P when it was all said and done, right? But that doesn't matter. I'm not trying to find the spread that has a ceiling at my upside target, right? Because if I get into this at 2304 and we rally another 10 points to the upside, well, then what is my profit on that? I've made $100 and I can get out of the spread. Just like I don't need to hold this to 2290 if we sell off. Maybe the market pulls back and I'm able to get out of these a little bit lower. And what is the difference? What is the the value of the spread here? Right? One of these ticks is $1. It's $1 per tick. So if it's 6 ticks wide, what's the market maker spread? It's $6. I mean, the S&P futures are 1 tick wide all the time, and that's $12.50. So I'm actually giving up a lot less. I'm not giving up very much edge here. Is my point, right? Especially if I can work into this mid market. Yeah. So let's say that I get into this at 2304. Well, the market rallies. I can be taking profit targets off along the way, right? Someone says, is there a way to manually make the floor higher in the spread? No. So these are the spreads that are available for today, right? Some of them, as you can see, are already way in the money, right? So take a look at this, and this is a good example of where the markets act much differently from the underlying. Here we have the 2250, 2290 spread, right? Market's 13 points above the ceiling of this spread. So why would someone want to trade this? Well, one, if they expected the market to slam lower, they could sell this spread. But you can see here the market maker has no offer. They're not going to let me buy this spread right now, right? They're not going to let me buy this spread. I could sell it, but I'm not going to be able to sell it for $22.90. Why is that? If I was able to, I would have no risk. I would have no risk in the spread. All of the potential reward is to the downside because we're at the top of the spread. We're well through the ceiling of the spread. Someone says, so I can't have a stop loss within the spread making the floor higher? No. You can exit the spread whenever you want. So if I get into this trade at 2304 half, all I need to do to get out of it is sell it at whatever price below this I feel like getting out of the trade. What's important to understand is that that price that I can get out of it will never be lower than 22.90, right? But if the market moves lower, let's say the market moves to 22.97, well, I can exit this there if I wanted to. I can't change the floor of the spread, but I can just sell it at the current price. Does that make sense, Brian? Yeah. So I can be as active as I want in management. If I am someone who looks at this and says, you know what, I don't really think that this is that bad of a trade the way that it is, I'm willing to risk 145 to make 255. I'm just going to put it on, then I can do that and not look at it again because I already know what my risk is, okay? So let's look at an example in another market. So yeah, there is no stop loss order type in the Nadex platform. You do just have to watch it for that. For profit target, I could put an order out there and let it rest, right? But I can't put a stop order in to get out lower. I just would need to be aware of where it is. Yeah. So let's take a look here. So like we were saying earlier, in crude oil, oh, these are the binary, sorry. Like we were saying earlier, no, I want the spread. I can trade pretty much any market I want with these. So the crude oil close is coming up. in about 45 minutes. Here we have the crude oil binaries, and we know that crude is trading around $53.10. Okay, so with that being said, what do we have here? This is a really interesting looking spread, in my opinion. We have the 52.57 spread for the expiry today. Remember, market's at 53.09, and where is the spread? What's the bid offer spread? 5 ticks, right? So being 5 ticks, I know that the spread is $5 wide. Let's say that I try to get here at 53.10. Well, because I know that this is a $5 wide spread, the floor is only $1.10 below where I'm trying to enter the spread. So my maximum loss is $110. The ceiling is what? $3.90 above where I'm trying to enter the spread. So my max profit is $390. Now I don't expect the market, or wouldn't expect the market to rally $4 by the end of the day to 57, so I would manage this with profit targets above here somewhere. But what's nice about this is that if the market slams lower, I know that it will never settle below $52. So on a day like a crude oil inventories day, this would be something that could kind of manage my risk for me, right? Does everyone see how that works? If the market moves from 53.10 to 54.10, I could exit the spread there. I would make $100. This making sense to everybody? Making sense? Making sense? Great. So we'll go over more examples, but essentially, spreads versus futures and stock, it's pretty clear which one is the more capital efficient approach. The risk and reward is clear from the onset of the trade. In spreads, I cannot see that risk increase or decrease. As soon as I put the trade on, I know exactly how much I can make and how much I can lose were the market to drift up or down through the ceiling or floors of the spread. I could use these smaller contracts to trade markets that I wouldn't be able to otherwise because they require so much less capital than futures or stock. We looked at a bunch of examples of why that is the case, right? They clearly offer the best risk management dynamics. I can become a trader of any market using binary options and spreads. And the trade setups here that we discussed are very simple, but I can use the binaries and the spreads for more complex predictions as well. So someone would like me to go to place an actual trade? Sure. So, and bear in mind, I have literally zero opinion on the direction of the price of crude oil right now. None whatsoever. Right, so the trade that we're going over here is purely and simply a hypothetical. I really have no clue where the crude oil market is going to move, okay? So, what do you want me to go over here? A long setup, or let's go over a short setup. How about that? So let's say that I think the market is actually going to move lower from this level. Well, I want to find a spread that gives me the potential to make a profit if the market does move lower below where it's trading right now, which is still around 53.10, okay? So the actual crude oil futures are trading 53.10. The indicative price is 53.09, so it's very, very close. So let's take a look at what I can do here. We have, again, the 49.5, 54.5 spread. So how wide is this spread? How wide is this spread in crude oil? Today's daily 49.5, 54.5 spread. $5 wide, right? $5 wide. So let's say that I think the market is going to move lower in crude, and remember, I really don't actually think that. I have zero opinion on the price of crude. I'm going to go ahead and get short. And what I'm going to do is sell these for $53, or try to sell these for $53.06. Now, actually, the market is a little better than that now, so let's try $53.10. So that order is working now, right? You can see I'm now the best offer in the world. So if I get filled here at 53.10, and I just did, what is my maximum risk and reward? Well, because I know the spread cannot settle above 54.5, I know that my maximum risk is $140, $1.40 until we hit the ceiling. So it doesn't really matter to me if this thing rallies to 54.50 or 50,050. My risk is always the same. Okay? I know that if we sell off and slam lower to the 59.5 level, that would be a huge move, but if that were to happen, I would make $360 per one lot. Now, in all reality, I know that the market probably won't move that much between now and the next 40 minutes from now. So how would I, put something in to manage this? Maybe I try to put in an order to buy this back if the market trades 52.5. So now I have a resting bid at 52.5. How much money will I make in the spread if I get filled at 52.5? Well, 53.10 was my entry price. 60 cents, $60, right? Makes sense? Makes sense? So we only have a few minutes left here. I do want to give you guys the chance to ask more questions. But before I do, I also want to let you know that we've got something special to offer you guys. We talked a little bit about the Ichimoku Cloud as a technical indicator. I have an ebook for you guys. It's completely free. We actually typically charge $10 for this. If you go to find it on Amazon, that's what you would have to pay to get it on your Kindle. But you guys can have it for free as being part of the Nadex presentation today. Please check it out. It's completely free. You put in your email address, you get the ebook. It's really, really good resource, and because this is a breakout indicator, it lends itself really, really well to trading both binary options and Nadex spreads. So please check it out. It's a great book. We really like it. If you're interested in technical analysis, particularly for binaries, definitely recommend this one on trading with the Ichimoku Cloud. Yep, just click the link, alphashark.com/Nadex. Just click the link. You'll be prompted to fill out just with your name and email address, and then you're sent the download right to your email. All right, so we only have about 6 or 7 minutes left here. Do you guys have any questions about anything we went over? Any last-minute questions here? Please feel free to leave them in the chat box. Does everyone have a more solid understanding of spreads now? A good number of you said you've never traded them before because you didn't understand them. Do you guys now at least understand what it is we're talking about when we're talking about these spread trades? Feel free to ask. Yeah, there's going to be a recording. Cool, cool. Oh, yeah, okay. So we did kind of touch on that, Brian, but I guess yeah, I didn't like explicitly say what the main difference was. So remember, we looked at that in the money spread in S&P, right? The comparable example here would be the spread in crude oil, right? So basically, what happens if I were to sell this in the money spread for $51.95? Well, I can't buy it because, right, it's well above the ceiling level, right? It's going to settle at 52 if nothing else happens here, if we don't slam lower. Now I can sell it for 51.95, but I also know that unless we slam below 52, it's going to settle at 52. So I'm essentially locking in a $5 loss unless the market gets smoked, right? So comparing that to a in-the-money binary, the in-the-money binary is going to still give me the ability to make a potential profit, but only because of the way that it settles. So let's look at the same daily option here. And remember that 52 was that ceiling level there in the spread. You know, what if I were to sell the 52 strike binary option? Well, again, I can't buy it, but I can sell it for 97. If the market doesn't slam lower, then the trade will lose $3, right? I'm given a worse setup in the binary, and why is that? It's not as good of a spread here, or not as good of a bid offer spread. I'm giving up more edge in the binary, and why is that? That's because even if we go one tick below 52, this goes to 0, and I make 97. For me to make 97 in the spread trade, I would need a much bigger move in the market because it settles to the price of the market. This needs to go one tick below 52 for this trade to pay off maximum. Whereas with the spread, I need a much larger move, and I start to make profit incrementally as it continues to move lower. Does that make sense? That's a good question, TJ. I don't think we necessarily would have time to get into that. So we looked at the setup in the spread, right? I can sell the 47.52 spread for 51.95, right? Or 51.90, whatever it was. The binary is in the money, and I can sell it for 97. Now, if we move one tick below 52, so if we go to 51.99, this thing goes to 0, and I make $97. Whereas the in-the-money spread, I make money incrementally as we move below 52. Make sense? Yeah, it's sent to your email, Paul. It's sent to your email, the book. So just click the link, put in your email address, and it'll end up in your inbox. Okay? Yeah. Say I bought a 100 pip FX spread for only 20 points above the floor, risking only $20. Since there has to be a seller, why would anyone want to take the opposite side, risking the $80? Because you're not going to get in at exactly 20 points, right? So let's say it's 20, like let's go back to our example earlier. Remember, the market maker makes money off of the bid and offer spread, right? So in something like, you know, the S&P futures, we saw that the market maker had about a 6-tick wide spread, right? So where they make their money is by giving me a slightly worse price that compared to the underlying market, and then hedging their position. Does that make sense, Chuck? So let's say, you know, I'm looking at this 100 pip FX spread and it's 20 points above the floor. I probably will be buying it for, you know, a price that's actually like 21.5 points, you know, or 20.5 points above the floor, right? So they're always going to get their edge out of that. That's how they get their edge, and that's why they transact. Does that make sense? Same thing, you know, same thing with with standard equity options or options on futures. They have a spread, they hedge, and then, you know, deal with it after that. Cool, cool. Alrighty, guys. So I'm gonna put the link in here again for you to get the ebook. Also, I'm going to put in my email address, james@alphashark.com, so you can feel free to send me any emails about this presentation, questions that you have about any of this. Please shoot me an email, and I will see all of you next time around. Thank you all very much for your questions. I hope you found the presentation to be informative, and I appreciate the time that you guys gave me. Everyone have a good one. And as always, happy trading.